to a person to attain and maintain an optimal level of functioning. Okay, so what's the impact of long-term care needs financially? Because this is a huge issue. 20% of people are going to incur over $100,000 of out-of-pocket long-term care costs. And that includes everything from nursing homes, assisted living, care in your home that Medicare doesn't pay for. And Genworth is sort of the big kahuna of long-term care providers in the country. And they do huge, massive surveys of costs. And their estimates are that the median cost of long-term care out of pocket is between $53,000 and $105,000 per year as of 2020. So I want to begin by looking, before we talk about actual policies, because this really frames long-term care policy, insurance policies. Let's look at the four major types of long-term care services and how they're paid for, and then we'll talk about the actual insurance policies and what they pay for and how to activate them. So first of all is in-home services. I did one of the workshops I did was the combination of home care and home health and who pays and whether Medicare pays or not. But there's two types of in-home services. One's personal care and the other is companion care, shopping, etc. All of the agencies in our metropolitan area charge between $27 and $30 an hour, and each of them requires 4 hours a day. Now, I would tell you that if you are sick enough to reach the level of being eligible to use long-term care benefits for this, you are likely in a position to need about 40 hours of care a week. And that means somebody in your home with you 8 hours a day, whether it's coming in to make your breakfast and coming back to make your dinner, sleeping overnight, etc. So that's the average, which is if you're paying out of pocket, it's $4,800 a month. It is not covered by Medicare, and people either pay privately or they can use their long-term care benefits. Another really major piece of our long-term care system in our country is adult day health centers. And these are not particularly well known, but I would say indeed, even in the suburbs, generally, like Montgomery County runs a few of them, Arlington County, in Alexandria, I forgot to say this, but I retired as the director for all of the aging services for the city of Alexandria. And we ran an adult day health program. And these are immensely helpful if a person is not safe for whatever reason to stay home alone. And most of the clients that we had either had a spouse that had to go to work during the day, or they were living with an adult child who had to go to work. So the adult day health programs fit the need completely, because we could have somebody, we provide transportation, they spend the day with us, we have stimulating cognitive activities, healthcare, we can manage medications. I'm sorry, that was way past tense, but and the cost of these are about $100 a day. So you'd be paying out of pocket $2,000 a month. It's not covered by Medicare. It is covered by veterans benefits, but getting that activated is always a real challenge. So this is a way to really help people stay out of an institution and in a very healthy way to go to work, and whether you're a spouse or adult child, and know that your parent or your spouse is safely being taken care of. The other is assisted living, and I don't know how much you will know about assisted living, but it's if you were to say that it was a money pit, it probably would be an understatement. But generally, the publicized fees for assisted living cover just room and board. And depending upon the size of the apartment that you choose, it's going to be more expensive. So if you opt for a studio versus one bedroom, the cost would be different. And I would tell you firsthand that even though it says assisted living, most of what services you receive are, it's like an a la carte menu, because the more assistance you need, the higher the cost is. And in our metropolitan area, the cost for assisted living is anywhere between $6,000 and $12,000 a month. And every service that's performed is an additional cost, and it's 100% private pay. And I want to tell you just about a real-time story about this. I have a neighbor who went to an assisted living facility that if I told you the name, you would recognize it immediately. And her family thought that she should have 2 showers a week. She resisted. She didn't want to have any showers, but they negotiated that. They said, okay, we want to pay for this. Now, paying for a shower supposedly costs $25. So their anticipation is that they would be paying $50 a week, which would be $200 a month extra on top of whatever this, $6,000 or $12,000. And what turned out is that they were actually charged for 7 showers a week, which cost $700 a month. And when they challenged the administrator said, well, we can't just staff up for 1 day or 2 days with extra nurses' aides to give showers. We have to staff up for the whole week. So practically every service that you get in assisted living is one that you pay for. And this is not covered by Medicare or Medicaid. So people either pay privately or they use their long-term care funds. So here's another topic. We did a whole comprehensive talk on skilled nursing. And this is another area where a lot of people end up paying privately. If you were in a hospital and you were admitted, you're not just in waiting, you're not in an ER, but you're actually fully admitted for 3 days. And if you need skilled or rehab care that's certified by Medicare, they said, yes, you need this level. Go to a nursing home. Medicare pays for the first 20 days if you continue to be eligible and you pay nothing. If by 21st day you have a condition that continues to require care, then Medicare pays everything except the daily copay, which has now gone up in this year to $194 a day. So if you were to get Medicare after 100 days, which frankly no one does, Medicare doesn't pay anything. But the full cost of a semi-private room in the DC area is $117,000 a month, and a private room is $138,000 a month. So let's look at how that would get paid for. So the 21st day on, that adds up to $6,000 a month. And I've heard people say, well, I've got Medigap coverage, or I've got a supplemental plan, Aetna, I have Blue Cross, whatever. The problem is when Medicare stops paying, the supplemental stops paying also. But I guess the good news is when Medicare stops paying, the long-term care policies will pay. The long-term care policies will do 2 things. They will pay the copay. So if you had a policy, it would pay the $194 a month. And when Medicare stops paying, the long-term care policy would then pay the full cost. But as you can see, it's mind-boggling when you look at $138,000 a year. That is a lot of money. So fortunately, long-term care insurance would pay for it, or some people have to pay out of pocket. Their personal savings because they don't have a long-term care policy. So let's look at, if you don't currently have long-term care policy, what are the predictors of who should buy it? If your parents or grandparents lived into their 80s, then you likely will also. And the longer you live, the more likely you are to need long-term care. Women live longer than men, and they have a greater chance of being alone and needing long-term care. And people with a family history of health problems like heart disease, dementia, etc. Think of the DNA pool. If you have arthritis, it's likely that your mother had arthritis or heart disease across the board. And married couples, if one spouse goes to a nursing home or assisted living, the other spouse probably needs funds to continue to live. So to buy a long-term care policy, the long-term care would be paying for the care in the nursing home or assisted living, and then the person would have their Social Security, whatever their pensions are. So what are the rates? Now the rates, when you buy it for the first time, the rates depend on a lot of things, some of which is just totally intuitive. the older you are and the more health problems you have, the more you're going to pay when you buy a policy. So if you buy a policy at age 45, you're going to pay less money than you would if you bought the policy at age 60. And I've got my next slide is a chart which shows that. Unfortunately, there's a real bias in this. Women pay more than men because they live longer, and then therefore they have a greater chance of using their long-term care insurance. For whatever reason, premiums are lower for married couples than they are for single. Another sheer bias in all of this. Insurance companies differ from one. I mean, some of the things are very basic, and we'll look at sort of the basic tenets. But if someone is considering long-term care insurance, it is absolutely imperative that you take your time and compare the company's policies and how much they cover and how long they have you wait. So the other thing, the other cost factor in all of this, and this is one that you have control over, is that the richer the coverage, such as you have higher amounts that you pay, that you're paid on a daily basis, or the cost of living adjustments and shorter elimination periods. So the more rich and robust your policy is, the more it's going to cost. So here's the chart. If you bought $165,000 long-term care policy at the age, a male at the age of 55 would pay $950. But look at the jump if you're a single female, which takes us back to the previous chart that women pay more than men. A couple would pay $2,080. Now, if they jump ahead 10 years, look at the difference between now men at age 65 are paying $1,700, and a single female is paying another $1,000 a month more than that. So this just sort of gives you an idea that if you don't currently have it, be prepared if you're older that you're going to be paying more money than you would if you were younger. So again, how old you are when you buy the policy, the maximum dollar amount that the policy is going to pay per day, and you pick that. That's one of the choices that you have to make when you're buying this policy. You're also choosing the maximum number of years that you get covered. And then they have something called a lifetime maximum, and that's spelled out either the lifetime maximum either is the number of years that the policy covers or the maximum dollar amount. And again, that's one of the choices that you make when you're picking the policy. So let's talk about the sort of basic tenets of a long-term care policy, because we already talked about what long-term care means. It's improving and maintaining current status, if not improving, but certainly not curing. We know it's chronic illness, so we're talking about the long haul here. So the traditional policies, long-term care policies, work a lot like auto insurance or your home insurance. You pay the premiums and you make the claims if you need the coverage. And as I said previously, you choose how much coverage you want, and then depending upon what you choose, that's how much you're going to pay for the policy. And the typical policies will spell out how much you'll receive on a daily basis or monthly, up to whatever the dollar limit is, or you pick a certain number of years of coverage. So different, intuitively obvious, different amounts for different care. Generally, the rule of thumb is that whatever the amount that the policy pays daily for either a nursing home or assisted living, 50% of that will be paid for home care. So let's say you've got a benefit of $300 a day for nursing home or assisted living, and your home care is likely to be half of that. So your home care benefit is likely to be $150. Now, I personally have a bias that I think that's wrong because most people would rather age in place at home. But unfortunately, the way the system is structured, it's about half. The policy pays about half per day at home care than they would if they had assisted living. A person is going to be paying higher premiums for benefits that rise over the year to protect you from inflation. All of the policies have varying periods between the time you need the care and the time the benefits kick in. And I would tell you right now that that's probably the biggest shock that most people have, because they think that if they're sick, they're where the benefits start. And that indeed is not true. And as you pick your policy, you're going to see very clearly that you pick the benefit period that you want. So you pick, if it starts, you want the benefits to kick in at 30 days, you want the benefits to kick in at 90 days. So 90 days is the most common. They say, okay, if you're sick, we'll start paying 90 days after whatever that illness was that started, or whatever the trigger point was. Some people choose 180 days because it makes the policy the premiums less expensive, but that's a personal choice that you make at the beginning. So just in general, long-term care policies are designed to cover long-term services, but they're not limited to health. Most policies allow the use of a daily benefit in your home, assisted living, memory care, etc. Long-term care, this comes as quite a surprise to most people. They will reimburse the policyholder whatever the daily amount is for services, but you have to pay upfront and get reimbursed for most of these policies. And that comes as a huge shock to most people. Because if you think back to the chart that we looked at of the cost of all of these services, this is a shocking reality for people when they realize they're going to have to shell out of pocket to pay for this, and then they get reimbursed from the policy. Most of the policies are like that. Some, you could submit an invoice and they would pay the assisted living facility directly or the home care agency, but most of them are out of pocket upfront for you. So when you look at the policy, the terms, generally, most have limits of how long or how much they pay. So generally, policies will pay 2 to 5 years of coverage. Again, part of the choice that you make when you pick the policy. The daily benefits can be from $50 a day up to $250 a day. And as I said before, there's an amount that gets paid for facility care and an amount that gets paid for home care. And once your benefits begin, then the policies pay up to whatever the preset daily amount that you picked until you reach whatever your lifetime maximum is. So if you're considering buying a policy, there are indeed exclusions. A company can decide not to sell to someone who has a pre-existing condition or a disability that they've received treatment from in the last 6 months. So, for example, if a person already has a diagnosis of dementia or Parkinson's or stroke, they may be not able to actually buy a policy, which goes back to the issue of it's cheaper to buy it when you're younger because the likelihood of having that diagnosis is probably less if you buy it at age 45 or 55 than if you wait to 65 or 70. And most of these policies do not pay family members who take care of you. That comes again as another surprise because some people will quit their jobs to take care of the person in their homes and they cannot be reimbursed. Family members cannot be reimbursed. So another exclusion is if you have been diagnosed with alcoholism or drug addiction, or in many cases, the mental health diagnosis, things like bipolar, schizophrenia, clinical depression, many of those a policy will not be sold to those people, but the policies have to cover the biologically based mental illnesses like dementia. And most of the companies are going to require that you pass a physical exam before they'll sell you coverage. And someone might sell you coverage if you have some chronic condition, but they're going to charge you more money than if you had no chronic condition at the time. So, according to this American Association of Long-Term Care Insurance, only 12% of people get rejected at age 50, but you'll see 44% of people get rejected at 70 plus. So the message is, if you're going to be buying a long-term care policy, it's better, the younger you are, the better it is to do it. I mean, the less expensive it is to do it, and the more likely that you will get the coverage. So let's talk about one of the people on our call here today, and I were chatting for a minute before we got started about what the benefit triggers are. That's what they call them, benefit triggers. And that's the condition or the situation that indicate that you qualify for this coverage. And there are several categories here that would qualify you for coverage. And one is that you require coverage because you are injured or you're sick, and then your doctor or your healthcare professional has to certify you as being chronically ill. And they define chronically ill as you're expected to be unable to do at least 2 activities of daily living without assistance from another person for at least 90 days. Now, I would say that perhaps if a person has had a stroke, it might be possible that they would need in-home care, probably for the long term, but at least for a period of, and maybe after 90 days, they've regained enough strength that they won't need help. But this is how chronically ill is defined. And that's why I started out with my first slide talking about defining chronic illness and how one uses. And if you remember, the first slide was that 70% of people over the age of 65 are going to need some kind of long-term, chronically ill, are going to need some kind of long-term care. So the loss of functional capacity, what that's defined as is active personal assistance by a human being to perform at least 2 of the 6 defined activities of daily living. And most of these policies will use that inability to perform activities of daily living as one of the triggers to determine if you're going to be eligible for coverage. And activities of daily living are bathing, dressing, transferring, eating, and caring for incontinence. And if you're going to put, any note in the palm of your hand, these are the things to remember, because these are the trigger points that say to the long-term care insurance company, okay, I'm telling you, I now have lost my functional capacity. I need help to do at least 2 of these things. And so start the clock on the policy. Cognitive impairment is another big one, because if someone is diagnosed with dementia, and again, remembering that a lot of people use the term Alzheimer's, but the official diagnosis is probably going to be some kind of dementia. It can trigger long-term care insurance benefits because it causes a person to need supervision to protect themselves, or certainly needs assistance with the activities of daily living. But supervision is a big part of this. And when you think about what somebody would get from a home care aide in home, supervision would be it. So examples, people would forget to turn off the stove, or they start roaming the neighborhood, or they give money to strangers. Having had the 13 years of experience with the city of Alexandria, one of the 7 programs I was responsible for was adult protective services and also geriatric mental health. And we dealt a lot with people who had this level of dementia, where you'd find them out wandering up and down King Street, or a big one was people involved in, the Nigerian lottery scams on the internet. So this is a really important trigger to begin to get the long-term care insurance benefits, because clearly once that diagnosis, and this progresses at a pretty rapid rate for most people. So to actually activate your long-term care coverage, it requires certification by a physician. Again, back to the activities of daily living, that you can't perform them either because of physical inability. Remember, we talked about a stroke, multiple sclerosis, Parkinson's. You can't physically perform those activities of daily living without assistance, or that you have a cognitive impairment. As I said previously, most policies will pay the benefits when you can't do 2 of those 6 activities of daily living. And the first one that most people can't do, either physically or cognitively, is bathing. So if you have a policy that recognizes bathing as the first trigger point, it's really helpful in terms of recognizing that the person cannot do other activities of daily living. So this is another thing that comes as a huge, huge surprise to people. First, you have the benefit trigger. You meet all those criteria that we just covered. Next is what's called the elimination period. Now, again, it comes as a huge surprise if you haven't read the fine print. And this is defined as the amount of time that has to pass after the benefit trigger occurs before you get payment. And it's a little bit like deductible on your car insurance, except it's measured in time rather than dollar amount. When you purchase the policy, you're allowed to choose what amount of elimination period you want. And you can pick 30 days, 60 days, or 90 days, and that's the waiting period. And the shorter the waiting period, the higher the premium is. And that was one of the earlier slides that we covered. That's one of the choices that you make when you buy this long-term care policy. And I don't know about all of you, but if you have a long-term care insurance policy, I do, and I've had one probably for 15 years or so, but I certainly couldn't tell you just off the top of my head what my elimination period is. So most people, if you already have it, have to go back and look at this. But this comes as a shock to people because most people assume I have long-term care insurance. I now meet the criteria. What do you mean I have to wait 30 days or 60 days for coverage to begin? So how do you activate it? Well, some policies, this is a little confusing because some policies measure that elimination period in calendar days and others measure it in days of care. So the average person gets about 3.5 days of care every week at home if they're in their home. Excuse me. And this makes the days of care waiting period longer than the waiting period for long-term care coverage. Excuse me, the elimination. So during that elimination period, again, remind you that you have to be paying for this care, which again comes as a huge surprise to people given the amount of dollars that I showed you on that previous chart. And before the coverage starts, the person has to be assessed by a nurse to ensure that the person is going to qualify for the benefits. So there's two types of policies. One is called an expense incurred, and that's where the policy pays the actual amount that you spent every day for the cost of services. And the other is called indemnity or a per diem. And that policy reimburses you at the same rate every day of service according to the terms of your policy. So let me show you the examples of those. If you have expense incurred, and you have a daily benefit that pays you $180 a day, but you only spend $130 a day for your home care provider, that policy is going to pay you $130. And then that extra $50 a day that you're not using is going to go into a pool of unused funds. And so that can likely extend the amount of time that they're going to pay the benefits because they're paying less money than they had anticipated paying. So they put aside that $50. I don't mean that literally, but you understand what I'm saying. In the per diem policy, they pay per day. So if you picked up a rate of $180 each day, they would pay that as long as you needed that care and regardless of what your actual expense is. So as long as you continue to be eligible for care, you would receive that per diem rate that was specified in your policy, whether you got services on that day or not. So let's talk about inflation protection. And let me go back and tell you that I am not an insurance expert. I'm not a broker. This is, it should be really broad brush because I mean, I'm not qualified to get into the weeds on this, but I'll give you sort of the broad brush. One is if you sign up, and again, this is part of the choice that you make when you first pick a policy. If you've picked a policy that has automatic inflation protection, and what that means is if you look at the cost of healthcare today and you look at the cost of healthcare 5 years from now, you can guarantee that 5 years from now, it's going to cost more, and usually about 5%. So what would happen in these automatic inflation is every year your benefits would go up by 5%. So you get 5% more coverage. So if you got $250 before, you get 5% more in the following year, but your premiums would go up accordingly. So generally, this adds to the cost of the premium, although some policies are different. But if you have the automatic inflation protection, there's at least a minimum, a bare minimum of an automatic annual increase of 3%. And beyond that, again, it's what you buy on the front end. And see, I think that's one of the challenges of even buying a long-term care policy. And I'm hoping that for those of you who don't have one, my hope would be that knowing the nuances and the specifics of this will help you make better choices. There's also one called a non-automatic, and I'll just speak personally about this. I have an Aetna policy, long-term care policy, and every 2 years they send me a letter and they say, would you like to increase your benefits? And they include a chart that shows if I increase my daily benefits by $25 a day, here's the amount of money that I'm going to have to pay in premium costs. And you make a choice if you want to add $20, if you want to add $100, whatever you want. But you know by looking at that chart how much your premium is going to go up. So the other thing too is the amount of increase depends on your age at the time that you're making that. So if I pick more benefits at age 70 than I had at age 65, it's going to cost even more money. And some policies are actually going to require they look at your health status again to decide if you're going to be eligible for more. So again, a nuance that is not particularly intuitively obvious. A lot of people, if they have at this point, one of the things that people can do is they can say, wait a minute, healthcare increases by about the cost increases by about 5% every year. Do I really want to continue to pay more money? Do I want to go instead? I want to buy some Tesla stock. I want to invest my money, even if I buy a CD. Am I going to do I really need this? Or do I have enough assets that I can afford to stay at my current rate of a premium? I'm not paying more money, but if the cost of healthcare goes up and I have to pay privately, can I afford to do that without this extra cost? So there are a number of things, and this is one of the reasons why we're going to make the handouts available, because there's just so much stuff in here. But some policies have what they call a waiver of premium, and that lets you stop paying your premiums once the company has started paying for your benefits. And some companies are going to waive the premium once they begin to pay immediately, and others are going to make you wait for 60 days. Someone earlier had asked a question about what if you pay in and you never use it, or what if you pay in and you only use part of it? If you have a provision in your policy that says they'll pay at your estimated premiums that you paid at the time of someone dies, minus the benefits you've used, if there's any. So you may be actually eligible, not you because you're dead, but your family, your estate may be eligible for a refund, basically, is what it amounts to, a refund for the amount of money that you've paid in, but you haven't used. But again, this is a clause in a policy when you first buy it. This is not automatic. All policies don't necessarily have this. One thing that's really important that doesn't cost any more money, believe it or not, is that most of these policies will allow you to name a person who they can contact if for some reason you haven't paid your premiums. And this is really important because, I don't know about you, but I live in DC and we probably get mail maybe 2 or 3 days a week. So it's possible that I might not have gotten the bill for the next coverage. So if I didn't pay the premium, for example, the person whose name I have down there gets the call from the Aetna and says, oh, MaryAnn Griffin is behind, she didn't pay, because they don't know. I mean, you might be dead for that point or something terrible might have happened to you. So it's really important that you name that. You can also, if you have this option, you can downgrade. I have worked with at least 3 clients who have been faced with premium increases of about 120%, and they simply can't pay it. So rather than drop coverage altogether, I've been able to help them negotiate for a lower premium. So you call the company, and it doesn't happen in one phone call, but what you're basically asking is, can I reduce my benefits? Either can I reduce the amount of money that I paid every day for the daily benefits, or can I lower the number of years for which I'm coverage? Because if you can do that, then maybe a person can retain the policy because the premium decreases. There's also something called a non-forfeiture option, and that's if for any reason you drop your coverage, and if you have this option, you'd be eligible to receive benefits for at least the amount of money and time you had already paid in. But if you don't have this option, everything that you had paid in up to that point in time is just gone. But having this option adds to the cost of the policy. And again, it's one of the choices that you make in the beginning. There's also something called the restoration of benefits. And that's a way to keep your maximum benefit even if you've received services. As long as you recovered and you go 6 months without needing any treatment or needing benefits again. This is a fuzzy one. I don't entirely understand this, and I don't know how much extra this costs. But if you think about what a chronic illness is, it's highly unlikely that you're going to be not using services for a period of 6 months. So what I think has been interesting, probably 10 years ago, there were 100 companies that offered long-term care insurance. I think they all thought, wow, this is a great way to make money. And I think most of them really have faced a shock of how sick people are, how long people are living, and how many people there are that are old. And just sort of a point of interest maybe for a cocktail party conversation. But beginning in January of 2011 through January of 2030, for 20 years, there are 10,000 people every day in the United States turning age 65. Now think about the magnitude of that. I mean, people have referred to it as a tsunami. It is a shocking number of people who've turned 65 in this country. So just the sheer volume of old people has really caused, I think, a lot of these companies to say, oh, wait, this is not going to make money for us. Let's get out of this. So the choices of companies have become significantly less. And many people, because of the increase in cost, and again, not expected necessarily, but they've seen increases between 50% and 125%. I know that a couple of years ago, I measured time by what's pre-pandemic. So probably about 2019, the people who had got John Hancock insurance through the federal government, basically we're looking at 120% increase in their premium. And people were shocked beyond words, as you can imagine. And so trying to figure out, how can I lower this cost? Because the problem is, if you drop the coverage now, and then you decide in the future that you'd like to have it, you may not qualify at all, because individual policies, as we said earlier, they require a physical, which means they require medical underwriting. So if you try to re-enroll or buy a new policy, you may not be eligible because you dropped the policy. Now you have a new chronic condition. You think you want it, and they're saying, "No way, Jose. We're not going to re-enroll you in this policy." If you have a financial advisor, they're going to tell you to do anything you possibly can not to drop the policy. So if you drop the policy and you don't have the waiver of premium or the non-forfeiture, you're going to likely lose all the years of payment that you made. So a preferred option is to try to work with the long-term care insurance company to modify the provisions to try to get the premium payments more affordable. I worked with a person who had long-term care insurance through the state of New Jersey, because she was a New Jersey state employee at one point. And she had probably the most rich long-term care policy that I have ever seen in my life. And it was basically benefits for life. I mean, literally benefits for life. So when her policy went up 125%, and she realized that she was probably not going to be able to pay, a friend of hers referred her to me, and through my private practice, we sat down and we spent many, many hours and many phone calls. But she was able to modify her policy so that instead of having lifetime coverage, she would have 5 years worth of coverage. Her daily benefit would stay the same, but it wouldn't go on for the rest of her life. It would only go on for 5 years if she needed it. And at the time, she was not using her long-term care policy, so she was planning ahead. So we were able to basically, because of the changes that we made, able to freeze the policy premium at that amount, and that she could count on the fact that because we frozen it, it was not going to go up next year by the 125%. So there are ways to modify this, but again, it takes savvy, and it takes, I think, intestinal fortitude to manage your way through that. What's going to be the paper maze. So here's the reason to keep the policies, and this is just a review of the first slide that we had. These are all out-of-pocket costs for people who don't have long-term care insurance. So this is why if you have a financial advisor, they would say, look, long-term care insurance is really important because here's what you're going to pay if you don't have it. So here's some considerations to keep the policy. And again, like I said, some of the premiums have become so cost prohibitive. So the question is, how much can I afford to pay on my own of those costs that we just looked at? And what are my assets? What's my monthly income? What are my other expenses? Do I own a home that I can sell? What if I consider going to a long-term continuing care retirement community? I mean, all of those are considerations when you look at whether to keep or drop your long-term care policy. Another consideration is, do I plan to remain in my home, and can I hire help there? Can I count on friends and family to pitch in on a regular basis to supplement a paid caregiver? And for what duration can I afford this? And if I require assisted living, can I afford $12,000 a month? So that goes on and on and on. So there are a lot of reasons that you would want to try to do everything you can to keep that policy rather than dropping it, because as you can see, this is what you're looking at in terms of expenses if you don't have a long-term care policy. Okay, finally, ways that you can, again, it's you can decline the inflation protection, or you could select a lower amount of inflation protection. You can, as I said, with the person that I worked with, you can reduce the maximum benefit, the number of years. You can take it from 5 years to 3 years. You can reduce the daily coverage that you have. So if you had originally $250 a day for nursing home, you could reduce it to $150 a day if you had, if you're trying to keep the premium down. Or you could lengthen the elimination period. You can go from 60 days to 90 days. And each of these will lower the premium, but it also potentially costs you money. Because, for example, if you lengthen the elimination period, that means that you're paying out of pocket for a longer period of time than you would if you had kept it at 60 days. So I'm going to take a big, deep breath. A lot of information to unpack. As I said earlier, I do have a private practice that I started when I retired, and the original intent was to help people navigate through the Medicare maze. But in just being in practice, I've had a number of people that I've worked with these kind of choices that they have to make for long-term care. So when we send you the handouts, my information is on there, and a lot of the financial data that I showed you can get online through Genworth or Kiplinger. But one caution with Genworth, when you look at they estimate a cost of care, cost of nursing homes, etc. Please be advised that, Idaho and Colorado and Kentucky and all of those, they literally look at the whole country. Everything in the DC metro area probably costs 25% more than it would cost someplace else. And so when you look at those numbers that Genworth has, they're an aggregate of the whole country, and we are paying much more let me look at the private room for a nursing home, $372 a day or $138,000 a year. So we are paying more in our metropolitan area than we would be paying if you lived in Kentucky or someplace else. So that's my only caution about Genworth. Let me stop sharing and let's see if we have anything in. Erica, can we see what?
I do have a couple things in the chat.
Okay.
Suzanne had a question about the elimination period. Is that each time you need coverage? So if you had a post-surgery recovery, how does that work?
Yes. For each event, there is an elimination period. So if you needed it for a short period of time and you used it, and let's say then the next time you have a stroke, for example, and you needed to use it again, you would have an elimination period when you had to use it again if you had a stroke. Did that answer the question? Okay. What else do we have in there? I see there's 6 questions.
A note here. I think it's important to note that there will be significant expenses even with a long-term care policy. My mom's didn't cover 100% of the costs, but it certainly helped, and that Medicaid only pays for nursing homes. And the next one, as we age with long-term care insurance, our management skills may soften. How do you recommend having a younger family member or such to be informed?
I am a really strong proponent. I mean, we actually did a whole workshop on the idea of having a surrogate decision maker. I am 100% committed to saying everybody should have a healthcare power of attorney and everybody should have a financial power of attorney. Somebody who can help you make your decision, somebody hopefully locally. That's a little easier than having somebody across the ocean. Somebody who's, if you can pick somebody who's 15 or 20 years younger than you, that's really helpful because you're going to have a built-in set of eyes of somebody who can say, well, or you missed your premium. So yeah, I absolutely think it. So you not only have somebody who's notified that you can pay your premium, but it's somebody who can help you figure out whether or not you can do all the things we said to try to keep your costs down. Did that answer your question? If I understood the question correctly.
Judith, did that answer your question? Okay, yes, it did.
Okay.
All right. Are there any online resources that depict state or regional specific cost estimates for long-term care?
Again, I think Genworth is probably the one that is most common. And again, my stated concern is that, let me tell you what you're going to find. If you go online, this is, first of all, I would say if you're online and you're looking, probably the first 10 things that come up, if you look at them, they're actually ads. And there are a zillion companies out there that, I mean, they basically try to get you in to help you with your insurance. So if you mistakenly click on an ad, let's say, rather than a website that's like strictly information, they get you in there, they make you put your name and your phone number and your address. I mean, they're basically mining data and then they will walk you through. So it doesn't, most of them don't cost money, but it's just a caution. If you're willing to give up your information, then yes. But with the Genworth ones, you almost always have to figure that we're in an area that's a much higher cost than their averages.
Another question. You mentioned that Medigap policies will stop paying when Medicare stops paying. What about regular health insurance policies that federal retirees will have?
If a person has, we're talking about just strictly skilled nursing care, skilled nursing rehab, when you're in actually a skilled nursing rehab facility, it is the same way because when the system is created in such a way that it is a supplement to Medicare, I'm going to claim that I do not know individual policy specifics, but I would say for the most part, the supplemental plans stop paying in a skilled nursing facility when Medicare stops paying because they're designed to be a supplement. What I would do if I were you is call or email the Office of Personnel Management and ask that question, or look at your policy, because I'm not 100% positive.
Thank you. Someone wanted to know whether a financial advisor can help with activating and managing long-term care.
Sure. I mean, there's no reason not to. They, somebody could say, you know, they could call the company for you. They could get things started for you. Most financial advisors have at least a pretty broad brush minimum understanding of long-term care insurance. And so I would say, yes, you're probably in safe hands with that.
Jim wanted you to know that federal retirees keep the same policy that federal employees have. It's not a supplement policy.
Okay, but is it a supplement policy if you're in a nursing home and Medicare stops paying is my question. My question back to him.
That is
because that's the only place where it would act as a supplement to Medicare. And so I honestly don't know, but I would seriously say, look at the details as it relates to coverage of Medicare in the nursing home. It's the best they can do.
Someone suggested contacting an insurance broker who specializes in long-term care and not a financial planner, as they are to manage your money and they are not specialists in long-term care.
Right, but I think the question that was raised
Yeah.
is, can they help you activate it?
Yes.
That was the question, not can they manage it.
Mm-hmm.
I would say, because I think, you know, the more you look at this, and that's why from the very outset, I put the disclaimer out there that I am not a broker, I'm not an insurance specialist, but I know what I told you. And I think one of the considerations, I mean, even as I was tooling around on the internet to just get updated rates and things, the interesting thing is there now are some policies that are sort of hybrid policies that are a combination of life insurance that you can convert to health benefits. So absolutely, if you can find an insurance broker that deals with long-term care insurance, that's the sort of epitome of people who would be knowledgeable about that. Because I think because there's so many people that are aging, and rather than getting out of the field altogether, some of these companies are saying, okay, how can we continue to provide both? And those are kind of interesting. I sort of felt when I was looking at it, if I had more time, I would plumb down and explore the details. So yeah, I would agree with you. That's probably the best choice.
Thank you, MaryAnn. The other things in the chat were all just things saying how wonderful this presentation was. And I would like to reiterate that you had so much information in there. This was fabulous. And I think clarified a lot of things and brought up questions for many others, but this has been wonderful. And I hope that everyone will join us. MaryAnn's going to do another presentation on March 9th on observation status, which is something that is just so confusing. And I am so glad that you're going to be doing that, because
I thought it's February 9th.
February 9th. Did I say March? I'm sorry, February. I'm already in February.
It's the final of the 5 workshop. When I signed up to do this as a volunteer, I guess I had sort of not anticipated like how many hours go into putting 5 separate workshops together. But yeah, well, and I hope today was helpful. I think, you know, as I was even putting the slides together, I was just sort of feeling it was daunting. I mean, it's daunting. It was daunting to me, and I've been in healthcare for 30 years. So just putting it all together, it is very, very confusing. And there's so many parts to it that I hope that today was at least a broad brush overview of the kind of things to consider, particularly if you're buying at the outset, or if you're considering dropping, because I think modifying is more helpful than dropping. And I just want to throw that out there. And are there more questions?
There's one more. Shirley has a question.
Okay.
Unmute yourself.
Yes.
Shirley.
Well, one thing that wasn't mentioned in your presentation, and I did this years ago when I signed up with GenWork back in 2003, that I decided I'd pick the payment option of annually so that I save some money instead of paying it monthly. I don't know whether is it common with other plans if you pay it in one lump sum that you pay less if you can afford to do it like that?
That's a good question. I actually, just for the sake of sanity and keeping the policy, because the mail's so bad, I paid my Aetna policy in full. I did the same thing you did. I paid for the whole year up front. I don't think I got a lesser rate, but that would be a really good question for people to ask if they're buying a policy, or even if they have a current policy that they could ask. Gee, if I paid this in full. So thank you for bringing that up. That's a good point.
And my other question is there some place that ranks policies? Because I'm assuming that GenWorth is a good policy. I got it through somebody that was, came to the Library of Congress and spoke about it. And then I signed up. This is before the federal government had anything, which they did about 3 to 5 years later on it. So how would, I'm going to go back and look at my policy because I haven't looked at it in years in terms of the points that you made, because I found your presentation very helpful in terms of what to look for. And I have some friends that weren't able to be on today, and they wanted me to bring up some points. So is there something that kind of ranks policies, or there's nothing out there?
Well, not that I'm aware of, but then again, the global network, there could be. I don't know that I mean, you could Google that and ask that question. And I wonder what we did before Google, It's our answer to most things. We'll just Google it. So, I don't know that if you actually find one, you could maybe email back to Palisades Village, because that would be a good information to share with other people, especially if they're trying to buy one. I mean, the earlier, I think was loud and clear, the earlier you buy the policy, the less expensive it is. And then you read you start with the fine print, what options you want, what you can pay for, et cetera, because it's pretty, as you know, it's pretty confusing. So, and if you have a policy, go back and pull it out. I did the same thing again, actually, getting ready for this presentation. I pulled mine out. I said, okay, now what is my elimination period? So.
Yes. And the last question is, so Palisades Village, when did you say we'd get a copy of her slides? Of the handout? I think.
For Erica. Well, we're going to convert it to a PDF and then we'll send it out. So probably within the week, early next week. I don't know what Erica's workload is, so I can't speak for her. So it's going to be
As soon as possible, but within the week.
Within the week. Okay, I'll tell my friends that I'll send it to them afterwards, and they'll find it helpful. This was very helpful that I had heard another talk you had given, and I said, I'm going to be on it. I'm going to come again. So I'll be here February the 9th as well. Thank you.
Return visitors, thank you. That's gratifying to know. Thank you so much. That's helpful. Thank you.
We have time for one more question. Someone wanted to know who would be the best person to help you decide whether to buy a policy or self-insure. Would you go to a financial advisor or an insurance broker?
I would start with a financial advisor, because you're going to look at what your income and your assets are. Are you in a position to pay out of pocket? Do you have enough assets to pay out of pocket if you need to have home care? Remembering that slide with the estimated costs on it. And for how long could you pay that? Versus, you basically make a chart and say, because keeping in mind that even with the long-term care policy, you are paying out of pocket during that elimination period. So you may pay 30 days, 60 days, 90 days, but take that chart that I made and look at how much you're going to pay out of pocket until the period kicks in. And so I think a financial advisor is absolutely the way to go.
Thank you, MaryAnn. This was
Thank you. Thank you. I appreciate the feedback. Thank you. That's the whole goal of this, right, Erica? It's just keep people well informed. And
Yes,
thank you,
because
Shirley. Thank you, Shirley, for being a return attendee. That's a great compliment.
Before you go, can you tell me what observation status means?
In a nutshell, it's if you're in the hospital and you could be in a bed or on a gurney, you could have a wristband on, but you're not admitted. According to their records, you're still in the observation status. They're trying to make a decision whether or not you qualify for an inpatient stay. So are you sick enough to qualify for an inpatient stay? And if you join us February 9th, we will go into a huge amount of detail about what that means, because the important part of not being in observation status is if you are sent to a rehab facility or a nursing home and you haven't had a 3-day admitted inpatient stay, there is no Medicare coverage for skilled nursing or rehab, and you're paying completely out of pocket. And that comes as a huge, huge surprise. And there are a lot of expenses that you're paying for if you're in observation that you wouldn't be paying for if you were admitted. So
No,
join
great.
us
Thank you so much. Yeah, I
join
look
us
forward to it.
February 9th. Okay, thank you, everybody. This has been great fun. We will get the handouts out because there's just too much information to remember. So I really appreciate everybody who was on the call, and look forward to seeing you on the 9th so we can talk about observation status.
thank you. Thank you all for attending.